All right, what is going on, everybody on YouTube? Griffin here, coming back to you guys with another live stream from the Millennial Motivation Entrepreneur YouTube channel. First and foremost, if you're going to be tuning in for the first time, we'd love to have you here on a regular basis. Definitely consider hitting that subscribe button below, hitting the bell icon right beside it. That way, you'll be notified every time we go live or upload another video. So coming back to you all just one day later, obviously we had our Sunday stock watch, stock talk, that kind of thing that we do every Sunday. And today was a pretty decent day overall for the market, I would say. Up about 3.5%, depending on which index you're looking at. Taking a look at the futures right now, the Dow Jones futures is up just about 1/4%, up 63 points. Take a look at the S&P. They're also up about 1/3% as well. And if we take a look at the Qs, they are up as usual, just slightly more at 0.38, up about 30 points on those as well. And then obviously I'll give you guys a broader look at my portfolio. Didn't really have a lot of changes going on, a whole lot of canceling each other out. Have some winners, have some laggards. At the moment, we took a few more positions on since I talked to you guys last. We bought one share of VTI, one share of XLK, which are in the green a little bit at the moment. They're each up combined roughly $5 to $6. Still holding target. We did sell our SDAO shares earlier, or our one share to hedge that we used to hedge the portfolio. Sold those this morning. Definitely was a good idea to go ahead and do that. We did that around like $49 or something like that. And we bought it back in, and it is down about 10 cents. We just bought that right before the close at 7 p.m. Central Time. Still holding the NCLH, only 5 shares, very small position. 1 share of Coke, 1 share of JP Morgan. You can see those are now in the green. Our biggest laggards are NCLH, obviously a cruise line, and then DAL, obviously an airline. Not surprising that those are 2 laggards. We'd be up pretty well. If those were just canceled out alone, we would have been up another 10 to 15 bucks today. And then we did buy a little bit of AAL, just a little tiny position, 5 shares. We're up about a quarter right now on those. Just buying in a little bit of these sectors again that are hit the hardest: airlines, hotels, if you wish. I don't really do hotels, but airlines, hotels, cruise lines, those have obviously been hit the hardest, and that's why we have our toes dabbed in the waters just a little bit. I mean, we have maybe total 60, 90. We have somewhere around $150 total. Nothing crazy. I mean, less than 10% of the portfolio is what we have invested in these. So again, just want to give you all just a quick update about that before we get into the whole point of the video. And before we do, I just want to make sure that we are up and doing all right. Looks like we got one of you tuning in so far, so hopefully we'll have more of you tuning in here in a few minutes. And if you all like the stream or anything like that, like it, don't like it, feel free to hit the thumbs up, thumbs down. I just want to get what you guys are liking at the end of the day. So, to the whole point of the video, the stream of tonight's topic, which is just ETFs that I like, that I know a lot of people like, and kind of like what they are, what's the difference between like your ETFs, index funds, mutual funds, that kind of thing. So, just straight up, I mean, from what I've noticed, the biggest difference between, say, there's more differences between ETFs and mutual funds than index funds versus ETFs, and vice versa. There's way more differences with index funds versus mutual funds, and one of the biggest just seems to be expense ratios and whatnot. Mutual funds tend to be a lot more expensive in the sense that, I mean, they can go all the way up to 2 or 3% in a lot of cases, which means even if your portfolio is down, let's say 5-10% this year, it's going to be down actually 8 to 12% because they're still going to take their 3% if you're making money or not. Same thing with the ETFs, but the ETFs and index funds, they're almost nothing. And we'll dive in here in just a second, but that primarily is your biggest take away that you should take away from like the differences between ETFs and mutual funds and that kind of thing. So I have here just a couple. I mean, there's so many different companies. You have iShares, Spiders, Vanguard. There's so many different ones that offer like ETFs and mutual funds and that kind of thing. Charles Schwab, all those, they have their own ETFs and mutual funds and index funds, all of that. But the ones that people tend to use the most are either Vanguard or Spiders. I would say at least 70% of people would say they associate with one or the other, or even both. And I myself, as you all could tell by my portfolio, even though I'm holding very small positions, of course, I'm even in both Vanguard and Spiders right now. So we'll just go over here. I just kind of want to just give you all a breakdown, and obviously you guys can like look all this stuff up, but that's the whole point of these videos, is to do it for you guys, of course. So prime example here, see expense ratio, 0.04% on an ETF. And if we want to, and this is for VUG, I believe. Yeah, it's the growth ETF. Vanguard Growth ETF VUG. What I like about Vanguard's website is very user-friendly and breaks it down easy for newer investors. As you can see, it'll tell you your risk potential. I like hanging out between that 3 and 4 range. I don't want to go to 2 or 1 because you're really not making hardly any money. You're barely keeping up with inflation in most cases. 5, I wouldn't really, I mean, it takes a lot to get a 5 from Vanguard, and those are very, very volatile a lot of times. I would say those are like more of your like aggressive growth, so to speak, and I wouldn't say don't touch them, but I would definitely say I wouldn't allocate more personally than probably 10 to 20% of your entire portfolio in like super aggressive growth, of course. But, and then again, you can come down here and you can see the performance. Over the last year, this is up 37%. Obviously, we had a crazy year the last couple years. 3 years, it's up about 20% since Trump's been in office, essentially. And this is as of the 31st of 2019, keep in mind, the end of the year. So it's not taking into account anything that's been going on this year. I believe this will actually probably update tomorrow, possibly. It might wait until like April 1st, April 2nd, because that stuff can take a couple days to populate and whatnot. But I believe these update every 3 months. Don't quote me on that, but I believe they do. So you might want to stay tuned and look at that. But you can see just the average rate of return. You can see since this fund has been up and going for about the last 16 years, it has done an average rate of return of about 9.75%, which is outperforming the market. The market usually only does somewhere between 7 to 10%. This has done pretty much 10% over the last 16 years, and even the last 10 years has done about 14.6. But it's a growth ETF, of course. It's supposed to at least outdo the market a little bit, or come very close to it in some cases. So let's see here. And then again, you can just kind of get just your general breakdowns, characteristics of the funds, all that good stuff. Its largest holdings, so you can get a good idea of, a lot of times people will kind of take a look at what these funds are invested in and kind of create their own portfolio on, say, like M1 Finance, those apps where you can buy like, what they call them, fractional shares, that kind of thing. Me personally, instead of trying to like copy a fund or try to mimic the fund or outperform the fund, I would just say you might as well just go ahead and hop in the fund personally. But I'm not saying that you guys should invest in VUG or anything. I'm not in it. I just use this one kind of as a just something to compare to. So if we take a look at VUG again, 0.04% is very, very, very low for expense ratios, and that's what Vanguard is most known for. Now if we go over here to Spiders, let's see here, which one should we click on that will come somewhat close? I guess since we're talking about a growth fund, we can just stay on the technology one, because technology is going to be kind of more of a growth, aggressive growth, so to speak. And if we take a look here at the performance of XLK over the last 10 years, it has also done a total return of roughly 16.75% since inception. Since this fund has been originated, it's done about 6.75%. So there's not a huge difference really between that fund and say this Vanguard fund here. The Vanguard fund actually there's quite a bit of a difference, actually, about a 2.5 to 3% difference there. And also keep in mind 0.04% in fees. I believe this fund here, if we go look at the snapshot, I believe the XLK is about 0.13. So it is almost 4 times. It's pretty much 3 to 4 times more expenses. Again, still pretty dang low. ETFs and whatnot tend to be pretty low in fees and whatnot, but still, it is 4 times more. So you get essentially another 0.1% more than you would investing in just say like a XLK. Now these, again, they're not gonna exactly like mimic each other because this is strictly technology. But I do not really use this website a lot, so I don't know. It's only showing their actual sectors like technology, real estate, consumer staples, all that good stuff. I don't know actually if Spiders even offers funds like Vanguard does, in that sense that like you can have growth and income, those type of things. But generally speaking, Spiders and Vanguard tend to have the lowest of the fees when it comes to fees. But honestly, guys, like fees should not be one of the main things. Like when it comes to investing in ETFs, index funds, the fees are pretty much zero, obviously. But ETFs, index funds, and even mutual funds, you're going to pay attention to them a little bit more. Because like we mentioned, I mean, mutual funds can go all the way up to like 3, 5, 6% in some crazy cases. So if you're going to be investing in mutual funds, we can even take a look at like Vanguard's mutual funds, for example. Those are going to be lower than most other mutual funds that you'll find out on the market. But let's see, let's do choose your mutual funds. So let's see which ones they show down here. It's not showing. Let's see. So I guess you have to actually sign in possibly to look at their mutual funds for some reason. I'm not signed in at the moment and I do not want to. Choose. I know whenever I do the ETFs, it will let me see these, but for some reason it's not. Let's see, review a short list. There we go. That might be it right there. Okay. So let's take a look at just, these are total market index funds, money market funds, U.S. bonds, balanced funds, and then U.S. stock funds. Okay, so here's what we're kind of want to go and look at. So U.S. growth. So we can see the expense ratio on this one, 0.4% essentially. 0.4%. And again, Vanguard, you can see, has some of the lowest ones. They're pretty much forcing everybody to pull their funds down, or pull their fees down. But like, let's click on this one, for example. This is what I hate the most about mutual funds. When you go to invest in a mutual fund, there's always a minimum. See, minimum investment, $3,000. Now, a lot of these mutual funds, once you get your initial investment put in there, the rest that you invest, I think, gets lowered quite a bit, and there might not even be a minimum after that. But to get going, you have to put down a decent chunk of change whenever you're investing in these mutual funds. If we click on fees and minimums, we can see here. So see, like I said, it goes down to pretty much zero. Additional investments, minimum of $1. But no matter what type of an account you're using, the minimum investment is $3,000. And see, Vanguard even lays it out here for you. It says this is what our fund expense ratio is. The average expense ratio to similar funds is over 1%. So just another reason why I generally do not like mutual funds is, again, just those heavy expense ratios. Even the Vanguard one being at 0.4%, 0.39%, which is pretty low, obviously, compared to other funds, it's still like 10 times just if you were to invest in the growth ETF, if that makes sense. because ETFs are pretty much like index funds in the sense that they're not nearly as what causes, and some of you guys that are newer are probably wondering, well, why are there so many different fees? Why are the fees so different between funds? How are fees determined? All that. To keep it short and simple for you guys, like, fees are how the broker makes money. Obviously, they make money off of you through the fees, all that good stuff. And the higher the fee, the more highly managed the portfolio, like the investment generally is, the more trading that's going on. Because within that fund, you're not just simply buying a fund. You're simply buying a fund, but within that fund, you have brokers that are buying and selling stocks and whatnot within that fund. And that's why, like, obviously you can go over here to overview and it will tell you like what exactly, like we mentioned, what all the fund tends to hold. And again, they're not just simply buying and holding these forever, they're actively trading them. And the more actively traded that fund is, they're going to pass those fees and whatnot from the trade onto you, the investor, at the end of the day. That's how they make money. They got to make money, of course, at the end of the day. And again, you can see this one's at a 4. If we take a look at this one overall, this is not a bad fund, actually. We can see since inception, this fund is a very, very good fund. I mean, it's been around for over 60 years now, and it has averaged over 10%. So that's a pretty good fund for 60, 70 years to be at 10.5 to 11%. That is a very good fund. You can see it's comparing itself to the Russell 1000, and the Russell 1000 tends to barely outperform it. So again, everything's going to be kind of just up to your discretion at the end of the day. Seek like a financial advisor, because when you're buying these ETFs, like this video and this stream, it's not geared towards necessarily like the everyday trader, somebody that's trading in and out. This is geared more towards like your longer term investments, so to speak, because all of us obviously want to make money in the stock market. We all want to hypothetically do 20, 30, 40% returns, all that good stuff, day trading. But at the end of the day, you still got to keep in mind your longer term picture, your other accounts, the parts of your portfolio that are going to be performing for you for 10s, 20s of years down the road. And that's what I like about Vanguard. I mean, they're very upfront with saying, like, this is what you can compare this fund to. And you can see over the last year, the Russell 1000 has outperformed this one by a few percent. But overall, I mean, it tends to be within 1%. It looks like, hell, the Russell 1000 wasn't even around in 1959. So, and you can see, I love how this shows you, like, if you hypothetically put $10,000 in back in 2010, over the last 9 to 10 years, you would have multiplied your money 4x in the last 10 years. So that is not bad at all. That means you're doubling your money every 5 years, essentially. So pretty good fund there. That's actually not a bad fund for the first one to click on. Let's see. Let's take a look at some other ones. Go back again. Let's see. What's another? We got international, U.S. growth. I think that's the one we clicked on the first time. You got small cap. Let's take a look at the mid caps. This one has a very low expense ratio. Probably not a very actively traded type of fund where they're actively doing a lot. Very passive. It's been around for about 20 years, so it's reputable. It's not one of their newest funds, but you can see here the average is 9.46% since inception. And this is really what you're going to want to look at, is how long has the fund been active and what is the average. You don't necessarily care about the last 1 year or even 5 years. If you're looking shorter term, as in 5 to 10 years, then I guess you would want to look at that. But what I really want to look at for longer term stuff I plan on holding 5, 10, 15, 20 years or more, I want to look at this since inception date, and you can see that U.S. growth one has done pretty well. To put in perspective, I think the overall stock market, like I said, has done somewhere around 8 to 9% over the last 20 years. in this market, this fund here has done over 10.5%. Obviously, you take out that, you're doing pretty much 10%. Still not bad. Compound interest, say you invested roughly, let's just say for an easy number, $200 a month. I'm getting my compound interest calculator out here for you guys. And of course, if you all have any questions or any ETFs or whatnot you want me to take a look at on like TD Ameritrade to pull up the chart, just let me know there in the chat and I'll break it down for you. But again, the bad part about that fund was is you're starting out with $3,000 that you have to put down in that fund. And again, after your fees and whatnot, you're doing pretty much, we'll call it 10.25%, or 10.15% rate of return. Let's say you just put in $200 a month, nothing crazy, just $200 a month. Let's say you put that in there for 40 years, because I know I wouldn't say most, but a lot of my viewers, I know a lot of you are in your 20s, 30s. I know I got some of you in your 40s, 50s, and whatnot, but a lot, I would say, from what YouTube's analytics show me, it shows at least 65 to 70% of you are in your teens in some cases, but teens, 20s, and 30s. So you've got 40 plus years, most of you, to invest. So if you put just $200 a month into that fund, obviously we're talking about the U.S. Growth Fund again, and you had to start out with a $3,000 investment. Another reason I don't like mutual funds personally, but if you put your $3,000 down in that and then you invested $200 a month with, after your fees, a 10.15% rate of return, because that is what the fund has done for the last 60, 70 years, why would you expect it to change in the next 40? $200 a month would have 1.49, pretty much $1.5 million. So that right there just shows that I just made you a millionaire by the age of retirement if you're below the age of 30, essentially. Just by simply investing $200 a month. And now let's invest the average American car payment, which is now $525 a month. I found out this last week. If you invest the average car payment in America, $525 over a period of 40 years, again, $3,000 is what you start with because you had to in that fund. 10.15% interest after your fees equals $3.646 million. $3,646,396.73. So if you think, and if you're trying to think, well, can I live off of that? I don't know. Let's see. Let's say you had $3.65 million and you're supposed to live off of 4 to 5%. Let's just say 5% to keep it easy. If you live off 5% of that, you have $182,500 to live off of. Ooh, almost dropped my phone, in your retirement. And that is just simply based off of this fund. This doesn't factor in you investing any money anywhere else, just literally, which I don't suggest, obviously, for your longer term investments. But if you just invested the average American car payment into this U.S. growth fund, you'll be a multimillionaire by your retirement age. And it's all about starting early, obviously. The example we're using here is 40 years. Me personally, I'm going to be 23 this year. 40 years from now, I'll be 63. And you might be thinking, well, I don't want to retire at the age of 63. By the way, me either. That's why I'm so into the markets and whatnot. But let's say your time horizon's 25 years. Let's say you're in your 30s or whatever, you're just getting going, and you're wanting to retire before 60, which kind of sucks because there's more tax advantages for those that wait until they're 59, 60 years old, which I cannot stand. But let's say we're trying to retire early. Let's say we're trying to retire in 25 years. Let's say we know that we're trying to do that, so we're going to be more better with our money. Maybe we've paid off all debt like this guy, and we got things rolling. We're making more money as we get older, all that good stuff. And let's say we're able to invest $1,000 per month. So $1,000 per month, same fund, same all that stuff. 25 years, you're at $1.4 million still in 25 years. So in my case, I'd be 48 years old with $1.4 million. If I live off of 5% of that, that's still $70,000 a year. And my version of retirement versus everybody else's is going to be a lot different, because my version of retirement is just going to be working when I choose. I'm never probably going to really ultimately retire. I'm always going to be doing something. That's just who I am at the end of the day. But man, I could sit here and do these type of numbers all day with you guys. Like let's take a look at another fund, and we're looking at mutual funds right now, and we'll dive into the ETFs and whatnot. Kind of look at the differences here in a minute in terms of like your actual rate of return, which is what we're worried about at the end of the day. Let's see what's another fund here. I guess we could take a look at. Let's take a look at this international fund. So it's been around for about 40 years, about 10.5%. It's got about 0.4, so about 10% even. We're not going to break the numbers down on that because we pretty much just did that same example up here. Let's see. So all these seem to hover other than your super, what would you call them? I would just call them safe investments. I mean, look at the bonds. This is why nobody's buying bonds. Who wants to make less than 1% on their money? Who wants to make 3% on their money? I mean, these are people that are just trying to preserve their capital more than anything. 2.8, and these are money markets, which I'm surprised they're even doing this good, honestly. Ridiculous. But let's just take a look at one of these like total international bond markets or something. Let's do total stock market index. Well, let's not do that. I'm going to do a bond, total bond. So here we go. Just kind of look at the difference here. And I'm going to break down, break down the difference in the money. And Vanguard even does a pretty good job for you, again, with our hypothetical 10-year thing. So last year, bonds have had a pretty good rally. I don't know if you all been paying attention. Bonds have had a pretty good bump over the last year or so. This will probably go up even more as much as bonds have gone up lately. But overall, I mean, bonds, you're going to get somewhere between 3 to 5% for the most part. As you can see here, if you put $10,000 in 10 years ago, you're going to have about $14,000. Now, not a bad return, of course, 40% over 10 years. What is that going to be? It's going to be about 4% a year, of course. So, again, let's take that hypothetical because, again, same thing, $3,000, 0.05 expense ratio, nothing to really even take into consideration. Let's just call it 4%. Split the difference of that 3 to 5%. We'll call it 4% a year. Let's say all you did was put money in that for 40 years. Let's say you also put the average car payment, $525. If you put that in there for 40 years, guess what the difference is, guys? You're only going to have $635,000. That is why I do not like going below 3 on this whole, if you're talking about Vanguard's risk reward scale, I do not like going below 3. Once you're going below 3, you're going below that 6-7% threshold that I'm willing to go below in terms of, since the fund has been created, I like staying above 6 to 7%. I mean, that's just me. Now, once you get into retirement age, it's probably not a bad idea to go ahead and diversify your portfolio much more. And I'd even be willing to say you should probably have 10% in bonds roughly, just because it's a generally safe, pretty stable. I mean, you can see this fund was started up right around the crash of '01, and ever since then, it has done consistently right around 4%. Obviously, it's had, like we mentioned, a good year or so lately with the volatility in the market. But generally speaking, this fund is doing somewhere around that 4% level. So you're still going to get a good, consistent return on your investment. But again, I wouldn't really suggest putting more than like 10% or so into bonds until you're getting closer to your retirement age and you're wanting to conserve some of that wealth. Again, I'm not a financial advisor. This is just stuff that I've read up on, stuff that I've learned from the richest of the richest. I don't know about you guys, but I'm constantly listening to like audiobooks of like Warren Buffett, Benjamin Graham, Charlie Munger, just all those multi-billionaire, super wealthy people. Get me a drink here really quick. And before we get going, make sure we're still doing good, and we are. So now to the ETF side, because we spent a minute on the mutual funds. Now let's hop over to the ETFs again, since we kind of bounced around for a minute. So let's go over to ETFs. And again, guys, there's so many, so many ETFs out there. I actually have a list of just ETFs in my TD Ameritrade Thinkorswim. As you can see, I mean, I've got just a full list of just different kinds. I mean, we even got a pot one in there, pot X. That's an ETF that is very, very new. I'm not touching it or anything. You can see pretty volatile. It's only been around for not even a year. It's been around for about 6 months. I'm not touching it. I'm just keeping my eye on it more than anything. It's a global cannabis ETF. And when it comes to ETFs, you can have 2 times, 3 times leveraged ETFs. Those are ones that we tend to trade more than anything. Like I have a share of SDOW. So whatever SDOW does, or whatever the Dow Jones Industrial Average does, SDOW is its inverse, and it's going to do 3 times more of a move inverse of what the Dow Jones Industrial Average does. So today, the Dow was up we'll just say 3%. SDOW was down about 9 to 10%. So those highly leveraged ones you want to kind of use more so as a hedge more than anything, or you're planning on getting in and out of that investment pretty quickly within a few days or so at the most in most cases. But let's just take a look at. Let's just take a look again at, I'm getting an idea of one of the Vanguard ones we should probably take a look at. Let's take a look at VGT, for example. I believe that is a technology one for Vanguard. So we will do this, VGT. Okay, so VGT has an expense ratio of 0.1%. You can see it's pretty high on the risk-reward ratio. And we can see here, since the fund started about 16 years ago, it's done pretty much around 11.5% over the last year, up about 50%. Last 5 years, up about 20%. Obviously, that's because technology has been booming over the last 5 to 10 years now, thus outperforming the market by far. And you can see here, if you hypothetically put 10 grand in back in 2010, it would have gotten at a peak of around $53,000 to $54,000. So your money would have went up almost 5.5x in a period of 10 years. So very good return on this fund. I really like this fund, as well as, honestly, I like XLK. If I remember right, a little bit more. That's why I'm in XLK. We can take a look here at XLK, just kind of on a chart. What we'll do is we'll just do time frame. We'll go to max available, and we'll do a monthly chart. So you can see this fund has been available since 98. Had a low of around 11 bucks. Has come up all the way to 103 recently. Has a long way it could potentially fall still. Potentially, we can get into that in another story. But at the end of the day, what I liked is one, it's cheaper to get in. 2, if I remember right, let's take a look at XLK on the Spider's website again. Let's see, where's XLK? Right there. Get it pulled back up here. So see, its expense ratio is almost identical to Vanguard's. It's 0.03% higher, so nothing really worth freaking out about or anything like that. But if we go over to performance, we can see that, again, since it's incepted, it has actually, again, only done about 7%. So I actually might even want to reevaluate what I'm holding at the moment. But over the last year, it's done pretty much 50%. Where this one, I think it did like 47. 48. So again, only about a 1% difference, but since it incepted, this has actually done 5% higher. Now, what you got to keep in mind, of course, is this started about 6 more years after XLK did. So XLK has been around the block 6 more years than this. This has only been around going on 16 years now, where XLK has been going around for going on 22 years now. So you got to take that into consideration as well. There was a lot of technology volatility back in the early 2000s, between like 99 and 2001, somewhere in that period with when was the dot-com bubble and all that? Was that 2000 through 2002, something like that? I was so little. I was only like 5 or 6 years old, but something just to keep in mind with that, what you're really going to want to look at is like the 3-year, 5-year, I don't know what this 5-year, this is done. So 10-year, 16, we'll call it 17, 19, 25. So 17, 20, 27. So this is still outperformed slightly, about 1 to 3%. What was the 3-year again? 3-year was 25.5. This 3-year was 27.8. So that one again wins by about 2%. So actually, overall, I think the Vanguard one might actually be the better investment, in all honesty. Now, the main thing is it's a little more expensive to get in. You can see right now it's up. Obviously, pretty good day today, up about 4%. But it's trading around that $200 to $220 price range, where XLK again is trading around $82. So it kind of depends how much capital you have on hand. Obviously, again, you don't want to like put too much of your capital into one investment and whatnot. You can always rebalance your portfolio, sell some XLK, put it into VHT or VGT, at a later date. Just that kind of thing. Just like me, I went ahead and hopped in VTI. I really do like VTI because it trades similar to SPY and DIA, all those. But what I like about VTI, which I brought this up in yesterday's stock talk as well, what I liked about VTI is you're getting exposure to every single stock in the U.S. stock market. If we get it pulled up here. Now, there could be some good and there could be some bad with that, because obviously, you're talking every single stock. But if we take a look here, this has done pretty well. It's done 7.6% over the last going on 19, 20 years. Last year it did 30 to 31% 3-year. This is what I would call more so your general. It's just your general U.S. stock market fund, essentially. Like you're looking to essentially make what the market's going to give you, so to speak. This does have a 2% dividend. I will say that's like a 1.97 or 1.93 dividend that's paid every quarter, of course. So I don't know actually if these annual returns, I would assume they factor in dividends, but I do not know for 100% sure. That's something I will need to check on myself. But as you can see here, the 10 largest holdings make up 20 to 21% of the fund. And like I said, I really do like this fund. Honestly, the funds I like the most when it comes to like Vanguard and just ETFs overall. Like I said, we got my whole list here, but the ones I really like the most are VUG, VTI. I like VGT a lot. Obviously, we just talked about that. And I don't remember if it's VHT or VBK that I like. Let's take a look at each one. VHT. I kind of like VHT. It must be, what was that other one? VBK. I think it is VBK is the other one I like. Yeah, because this is the small cap one. So let's take a look. I like this VBK as well. This one, as you see, it's around $150. Again, a 5 on the risk-reward ratio. You can see this one's done closer to 10% over the last 16 years. Last year it did 32, almost 33%. Last 3 years, 15. Last 5, 10. It's pretty much hovering somewhere around 10%. 9 to 12% over the last 10 to 15 years. You can see here if you put 10 grand in it 10 years ago, at the top you would have almost quadrupled your money, about 3.5 times on your money. I do not remember what the dividend is on this. I don't know if it shows it either, actually. I thought maybe it would show. Let me look it up on my TD Ameritrade Thinkorswim. It's really easy on here. Where we have VBK. I think VBK's is really low because it's small caps. Yeah, it's only a 0.65% dividend, roughly 25 cents per share that you hold. So you're not going to get rich off the dividend or anything like that, but still nice to always have a dividend there at the end of the day. But yeah, I mean, those are just a couple that I like. And then when it comes to spiders, the spider ETFs, the ones that I really like are obviously XLK, which we just discussed. I kind of like Vanguard's a little bit more. I like XLRE, the real estate ETF. XLE is starting to get attractive just because energy has gotten hit so hard over the last few weeks. XLE and XOP, those two. I really like XLU. XLU is probably my most favorite spider ETF, and I don't think I even have it listed in my watch list, but I really do like the utility ETF. It tends to outperform the market when we're on the downward trend. If we take a look at the last 20 days, you can see, I mean, it's still dropped quite a bit, obviously, but it tends to outperform kind of in bear markets. Like you can see right now, this was up about 4%. I don't know what the market was up overall. I think it was like 3.25. So yeah, I mean, it doesn't outperform by like a hell of a lot or anything. But if we take a look, let's go over to XLU. I want to take a look just at its like overall performance for you guys. So its expense ratio, again, not too bad, just 0.13%. Take a look at the performance. Performance of it over since its inception is around 7.38% last 10 years. Again, when you're XLU is more of a defensive position, you're not necessarily looking for that aggressive growth, but even over the last 10 years, it's done about 12%. So that's really not that bad. What was that one we were looking at a second ago? Was that XLK, if I recall? XLK has done 17%. So again, when you're getting into XLU, that's taking on a little bit of defensive positioning. You're leaving potentially 4 to 5% off the table. But again, when you're getting closer to like that retirement age, or say you're investing in index funds, ETFs, mutual funds, etc., because like you're saving up for a house or saving up for some sort of big purchase that you know is going to take like 5 years, XLU isn't necessarily a bad option because it's a little more stable. It's not going to be like bond stable or anything like that, but it tends to outperform. Like let's look at just 1 month of XLK, and then we'll fast forward to 1 month. Now watch me actually be wrong here. So on the 1 month it's worse, but the last, the year to date, when was this updated? The 29th. So this was a month ago also, so that's why this is slightly off. And it's down slightly less year to date. I wish this was updated. I wish they would update these more than once a month. I know it's month end, but you would think it'd be updating any day now. I like stuff that's updated every day, not every month. That gets annoying. But generally speaking, the XLU is slightly more, tends to outperform in a bear market. I'll just keep it like that. If you don't believe me, just go back and look at all the bear markets. Utilities tend to outperform the S&P in general when the market is on a downward trend. So yeah, I mean that's a short little tour of just ETFs and whatnot. I've really been getting more into just ETFs, index funds, that kind of thing. Looking, obviously, this is the time you really want to be looking at just different types of funds and whatnot, with it being kind of a bear market that we're in right now. I mean, you had SPY, for example, just a generic S&P 500 fund, down $100 in the last 20 days. I mean, that's a wild move. You're talking over 1% a day, roughly. It's moving to the downside. Take a look at the 180 day. I mean, you can see down $122. I mean, from the high, that is, let's see, 339.38 to 217.75 is roughly, if I can get it close, 217.75. That's a 35.5% change. And again, what you got to keep in mind, guys, is whatever the market moves down, it has to move up twice as much to get that money back. So if the market's down 35%, it's going to have to move up roughly like 65 to 70% to make those gains up. So crazy good buying opportunity. We're still in a good buying opportunity. I would not buy on the green days personally. Because these moves we are seeing are still super violent. When we take a look at like the 20-day chart, or actually I want to take a look probably at that 4-hour chart. Take a look at the 4-hour chart. We could potentially even be forming yet another double top. We had one early on in this bear market, and we continued down because as you can see, we started coming down. We tried to come up for a couple days, and then we failed and we continued down. So it'll be interesting now that we've been trying to go up for a few days. We've kind of been staggering out between that 250 to 262 roughly price range. We're at 262.42 in the after hours trading apparently. Take a look at the markets overall before we log off here. I want to look at the Dow Jones. It's up about 100 points right now. So you can almost see, you can see the double top trying to form there. Very similar. The difference is we're not getting rejected at this SMA this time. So I'm slightly bullish because of that. I want to see us retest it. I think we definitely will. It'd be around 20,500 on the Dow. My whole point is, guys, is don't try to chase the market right now. I mean, it's up like 20+% in the last week and a half, not even week and a half, in the last week. Just don't try to chase it. If you're gonna try to chase it, then just buy very little bits, and then on the red days, that's when you buy more, of course. Just basics at the end of the day. But I'm thinking I think this 18,000 is the bottom for the Dow, in all honesty. We keep getting bad news, and it seems like every bad news or bad number we get, we seem to rally on that, and that tends to be when you're kind of at least spotting a bottom. Doesn't mean that we're just going to shoot straight up. No. Honestly, I wouldn't even be surprised if we test this SMA, potentially break it, and even retest those lows, retest that 18 to 19,000 on the Dow before we continue higher. Honestly, I don't think we are. I think we're going to test 20 probably. I think we're going to test somewhere around that 20,000 range, and when we do, I personally will be buying a lot. Hopefully the stimulus checks will come in by then. But yeah, I mean, it's still a great buying opportunity, guys. I mean, for us to go all the way back up to the all-time high, let's just say we're at roughly 22,200. Market's actually coming up a little bit this last minute or two. But for us to retest that all-time high, we are going to have to go up, 29.5 essentially? We'll just call it right there. We're going to have to move up another 33%. So, I mean, even if you were dumb and bought right now, which, again, I would not be buying at this very minute, but even if you did and we fill the gap back up to the all-time high, which probably isn't going to happen anytime soon, probably a year roughly, depending on when this corona crap goes away. But if you just simply bought it and held it, you're probably going to make 30% on your money, depending on, again, what you're putting your money in. If you're putting your stuff in those higher growth funds, you're probably going to make closer to 30-40% over the next 1 to 2 years, more than likely. So, again, just a very good buying opportunity that we've had over the last few weeks. Hopefully, you've been slowly putting your money to work. I know I've been putting just a little bit of my money, and I'm finally getting close to the date where I can now put all my 401k money back in. I went to 60% cash way back in here when we first started going down, mid to late February. And man, that was good timing. I tell you, it was right around the 25th, I remember. And God, I'm so glad I did that now, because obviously I saved myself a lot of headaches. But you have to wait 30 days before you can reinvest. So I should be able to here. I might actually try to tonight and see if it'll let me. I know I tried a week or so ago and it said I was still not within that 30 days. So we'll see what happens, and I'll keep you guys posted about that, of course. But again, as for like my total trades and whatnot, again, just taking very small positions at the moment. We're up overall $24 year to date. For those of you that are new to the channel, I just switched over to TD Ameritrade here this last week. So obviously my profit loss year to date is going to be very small, but the fact that I'm profiting in a bear market, I'll take it at the end of the day. And again, my biggest positions are going to be ones that I plan on holding for a while, and then I'm going to be kind of using just a little bit of cash to do swing trades and day trades whenever the trade's really going for me. If you're wondering why I'm still holding Target when I'm up 5%, mind your business, I guess, because I'm wanting to get $100 out of it, but it's struggling. So who knows? I might sell it before the end of the week. But no, I would like to get $100 on Target. That'd be roughly like 10 to 12% return, and it seems to hit 100 every time before it gets knocked back down. So that is the goal. But hopefully you guys did enjoy the stream. If you did, definitely make sure to smash the thumbs up button. I greatly appreciate that. And if you have any questions about ETFs and whatnot after the video uploads, feel free to shout it out in the comments. And of course, if you're not already in our Discord group chat, as you can see, there's people in here right now actually that I have to get back to here in a minute. But if you're not already in that group, it's free to join. I don't charge for anything associated with this channel. Just hit the link down below. First thing you'll want to do is download it on your smartphone, then create an account. It's free too. All they do is ask for your phone number. No, they're not going to spam you with emails, phone calls, anything like that. I'm not going to either. I don't get access to any of that information. I don't want it anyways. But that's all you got to do to sign up, and then just go to the link in the description box of this video, and it'll take you right there. We have like 150 of us in there now, and it's just awesome to communicate with a bunch of like-minded people looking to just find ways to make money in this crazy market that we are in. But hopefully you guys did enjoy the stream. Like I said, I haven't checked on it in a little. Hopefully the stream health and whatnot has done well for you guys. But again, if you're new, definitely consider subscribing. We love to have you here, and I will probably, like I said, we're trying to post at least every Sunday for sure. We do that every Sunday for our Sunday stock watch, stock talk deal we do every Sunday, and I'm trying to upload at least once, if not 2 or 3 times a week, just like little videos like this, and then just overall market updates for you guys. But until next time, guys, keep on going out there, making your profits, covering your profits, and achieving your financial freedom this year. And I'll see you guys in the next video or stream. Until then, take it easy, guys.